Don Edwards, a financial analyst, was tasked to prepare a report contrasting the financial performance of two retail companies, Sears and Walmart. His report will be used as an input for buying and selling decisions of investors. Walmart was the acknowledged powerhouse of the U.S. retailing industry in the 1990s. Sears had begun to revive the fortunes of its outdated, unprofitable stores. However, he noted that Sears' ROE of 22% exceeded Walmart's ROE of 20%, which made him wonder, which firm was the true powerhouse? While there are quite a lot of financial ratios to make sense of the overwhelming amount of information that can be found in the Sears and Walmart's financial statements, we will examine relevant financial ratios that are indispensable tools in making informed investment decisions. We will first take a look at the return on equity ratio, since this is the source of Edwards' dilemma. Equity is another word for ownership. ROE tells you how good a company is at rewarding its shareholders for their investment. This ratio indicates how profitable a company is by comparing its net income to its average shareholders' equity. It measures how much the shareholders earn for their investment in the company. The higher the ratio percentage, the more efficient management is in utilizing its equity base, and the better return is to investors. Below is the computation of Sears and Walmart's ROE for the year 1997. Walmart has higher net income than Sears, but surprisingly, Walmart's ROE is lower. This is because Walmart has a higher equity base, the denominator. On the other hand, Sears' small amount of net income, the numerator, produced a higher ROE off a modest equity base, the denominator. This suggests that an ROE in this case may not be a good profitability indicator. Hence, we examine another ratio, the debt-to-equity ratio. The debt-to-equity ratio measures the relationship between the amount of capital that has been borrowed, i.e. debt, and the amount of capital contributed by shareholders, i.e. equity. Generally speaking, as a firm's debt-to-equity ratio increases, it becomes more risky because if it becomes unable to meet its debt obligations, it will be forced into bankruptcy. Sears is highly leveraged at 85% to 15% debt-to-equity ratio, or 5.6 times. This means that the profitability of Sears as measured by ROE comes with a price, a lot more debt. The lesson for investors here is that we cannot look at the company's return on equity in isolation. A high or low ROE needs to be interpreted in the context of a company's debt-to-equity relationship. Cash flow. A smart investor should also look at the company's ability to produce plenty of free cash flows. It signals a company's ability to pay debt, pay dividends, buy back stock, and facilitate the growth of business, all important undertakings from an investor's perspective. Profit can often be clouded by accounting gimmicks, arbitrariness of estimates, i.e. unrealized gains or losses, depreciations, contingencies, but it's tougher to fake cash flows. For a 3-year period, Sears' cash balance had been fast declining, whilst Walmart's cash balance had been rapidly growing.